Hey guys, welcome back to RWM Finance. So our previous video was over 5 things to do before investing. Now today's video is going to go over 5 mistakes that investors need to avoid. I felt like I should give y'all some insight about mistakes that you should try and avoid. This way, once y'all hear them, then hopefully y'all will be less likely to make those types of mistakes. Some mistakes can wind up being pretty costly. So this way, y'all will know what to avoid and hopefully save yourselves quite a bit of money. So if you haven't subscribed, please scroll down and click that subscribe button for me, and then we're going to get to those mistakes to avoid. Alright, so now our first mistake that investors need to avoid is buying a stock based on its price and not on its value. Remember how Warren Buffett invests? He focuses on the intrinsic value of companies, which is one way he uses to determine which companies to invest in. He also buys stocks when they are considered on sale. So in order to do that, he uses the intrinsic value to determine a price that he is willing to pay, and if the stock falls below that price, then he will start to buy them. So he determines a price that he will purchase a stock at based on the intrinsic value of the stock. He's not just going out and buying different stocks here and there just because they're cheap. No, that's not the way to go. That's not the way he's going, and that's not the way that I feel that you should invest either. Warren only invests in excellent businesses with expanding value. So if you find an excellent business with an expanding value and its stock price is on sale, by all means go out and purchase it. But don't just go out and buy a stock because it's cheap. Okay, so the second mistake that investors need to avoid is not doing their research on a stock before purchasing it. You need to do your homework on any investment that you're thinking about getting into. Remember, Warren only invests in excellent businesses with expanding value. In order to determine if a business is excellent, then you need to do your research and homework and everything you can do to study up on them. You know, check and see how much money they're bringing in. Check to see how profitable they are in previous years and if their profit is continuing to rise. But don't just do research on the numbers. Do your research on the personnel that are running the business as well. Make sure that the company has a good group of managers and a good management team that's running it, because a company is only as good as the people that actually work there. The third mistake that investors need to avoid is buying and selling stocks based on their emotions. Remember my video over the Rich Dad Poor Dad key points? One of those key points was to take your emotions out of your thinking. More specifically, we need to keep our emotions out of our investments. When you invest with your emotions, you are likely to trade more frequently than if you are not investing with your emotions. By trading more frequently, you subject yourself to more fees and expenses. The more you trade, the more fees you pay. In fact, the buying and selling of a stock can end up costing you around 2% to 4% just for one or the other. Now, if you were to do a round trip buy-sell transaction, then that would end up costing you around 4 to 8%. So don't make the mistake of buying or selling a stock just because you have that emotion or that feeling that you need to. Keep your emotions out of your investments because they will end up costing you a lot of money in the long run if you keep them involved. Alright, our fourth mistake for investors to avoid is not being patient with their investments. Warren Buffett's favorite holding period is forever. If you invest in an excellent business with expanding value, then there's no time for you to sell that stock. Or if you invest in an index fund or an ETF that mirrors the S&P 500 or something that holds the entire stock market, the best holding period for that would be forever as well. I mean, has the entire stock market ever not come out of a dip or a recession or even a depression? No, the market always comes out of those. It continues to rise despite however much it falls. It keeps on bouncing back. Just on the topic of being patient with your investments, Fidelity conducted an internal performance review on accounts to determine which type of investors received the best returns from 2003 to 2013. This customer account audit actually revealed that the best investors were dead or they forgot that they even had accounts. This is it's just crazy, but I mean, it makes complete sense. The best holding period is forever, and these people that forgot that they had an account or that were actually dead had the greatest amount of patience because they actually forgot about it. So they just let their investment sit there and just keep earning interest and interest. And then that compound interest it just made them to where they had the best returns from 2003 to 2013. You have to be patient with your investments. That's the moral of the story. A way to help you be patient with your investments is to give your money a purpose and come up with an investment strategy. By doing this, it allows you to understand what your money is going towards, no matter what the market is doing. This allows you to practice the best investment strategy, in my opinion, which is to buy it and forget it. So you buy that stock, you buy that index fund, that ETF, whatever, and you just forget about it. You just let the compound interest just take over and let that stock just keep going up. Now, our fifth and final mistake that investors need to avoid making is listening to the crowd. If you want to become a better investor, then you need to listen to the right people. Do you know one of the reasons why the poor stay poor? It's because they listen to the wrong people. They listen to the advice of people who are not living the lifestyles that they want to live. When you want to get good advice, you go to an expert or you go to a mentor. You need to find someone that is living the lifestyle that you want to live and ask them for advice. This doesn't have to be a face-to-face or in-person interaction. There are plenty of people out there that are living fantastic lifestyles that post helpful videos every day on different, social media platforms, Instagram, Facebook, Twitter, YouTube, whatever. You just have to go and look. Finding a mentor can help you avoid making some pretty costly mistakes. So if you're going to take advice, make sure to listen to the right people. Alright guys, those are the 5 mistakes that investors need to avoid. I hope that you paid attention and that you will do your best to try and avoid those mistakes. Well guys, I hope you enjoyed the video. If you did, scroll down, give it a like, and subscribe to the channel below. If you have any questions, please leave those down in the comment section. I will personally try and respond to each and every one of them. Follow us on Instagram at RWM Finance. Remember guys, I post videos every Monday, Wednesday, and Friday. Make sure to tune in for the next one. One more thing to remember is to check out the list of books in the description bar below. There are some really helpful ones down there. I promise you they have really helped me out, so I know that they would help you out. As always, thank y'all for watching, and I will see y'all in the next video.